Recording. Okay, perfect. First of all, I thank everybody for taking your precious time on Sunday night and joining this webinar along with me. And I hope definitely I add some value to your time that you're spending for the next 1 hour with me here. So my name is Kumar Sharram, and today I'm presenting before you an opportunity to invest in an apartment complex, which is 446 units in Houston, Texas. My company's name is Pro Investors Capital. And for this project, I'm partnering with three other companies, Elevate, Care Ventures Capital, and Zurich Family Office. So I will go further details into the presentation, but the way I would like to keep this format is since most of you already have access, have seen this presentation because we have shared that and hosted that on the portal, and I'm assuming that most of them had a chance to review it. So instead of taking a lot of time to kind of go over the contents, and so I'll just try to cover it quickly, but try to leave ample time so that we all can have a Q&A and discuss the questions so that it's helpful for other people as well. Like if somebody answers a question, it also helps others when I give an answer for that. So I'll try to keep it in half an hour for the entire presentation, and the rest of half an hour or 45 minutes will exclusively give for the live Q&A. So before I begin this, I just wanted to give a disclaimer that whatever we are presenting in this presentation are the numbers based on our due diligence and to the best of our abilities in try to underwrite this deal and we are presenting. So any of this information, I would advise the investors to review for themselves, seek professional help, their CPA or attorney for any further guidance before they do any particular investment in this property. So with that said, let's move on. So first, let's start with a little intro about myself, what I have done so far, and why I'm excited about presenting this opportunity. So to put in, like, I'm assuming for the most part, folks who are live here in the session, I'm assuming that most are like engineers like me. I'm no different. I came to this country in 2001. I did my master's here in Clemson University, South Carolina. And I've been, I'm assuming most of you are from IT background. So myself, I've been in IT for almost a decade. And so my real estate journey started in 2010, where I started investing in corporate tenanted properties. And so we acquired some of the corporate tenanted properties early on, which we did syndications, which means group investments. So we bought a couple of corporate tenanted properties like the Dollar General, like Wawa, Dunkin' Donuts, this kind of corporate tenant properties, which we sold all of the holdings right now. Recently, we sold and generated good profits for the investors who are involved in these deals early on. And then later on, I moved on to buying foreclosure properties in New Jersey. And we bought around 70 plus properties in the time frame between 2015 to 2018 time frame, and all of them as distressed properties. So we bought them, rehabbed them, and hold them as rentals. So currently have 50 plus single family rentals that I own myself and I manage them. So that's my bread and butter. So with that, we also have that rehab and turnaround mentality because we've been through and done acquired a lot of the assets in due course of time and learned a lot about fixing up stuff and getting things and turning them around. So then the multifamily, so my natural, after buying so many single family rental properties and managing so many tenants and everything, so my natural progression was to get into apartment complexes, which I did. So in 2019, we started getting into the multifamily investing, and we started investing on a 250 unit uh, portfolio, which is a 150 units and 150 and 100 units portfolio in Atlanta, Georgia, which also we recently sold a few months ago. and we were able to again get a good IRR for the investors. So with that, unfortunately, 2020 we couldn't do much in the multifamily space, but 2021 we tried to make up whatever the last time and lost ground we had in 2020, and we started with 172 units in Longview, Texas, and later followed by 119 units in Lubbock, Texas, and then we also recently closed 125 units in Irving, Texas. I know you must be asking why everything in Texas. We are currently focusing on the Texas market, and it's not that we only want to invest in Texas market. We are a company, we invest all around the country, and we are trying to acquire assets all over the United States. So for us right now, we were able to make strategic partnerships with local partners in the Texas area, and that's why we are able to keep up the momentum and acquire good assets in the Texas market, and so on that followed, and that's how I presenting to you uh, the another opportunity in the Houston, Texas market. So we like Houston for the which I'll of course cover into why Houston and everything. So let me tell who are my partners in this opportunity and what is the strength that they bring to the table. One of Pro Investors Capital strategy is to always partner up with the local players. Since I personally live in New Jersey, I always partner with local partners. And here in this, my partner and boots on the grounds are these gentlemen here, two of them, which are actually the Elevate commercial, which is headed by George Abreu. Uh, George Abreu also runs a construction company by name JNT Construction. So George has been in this industry in real estate for a long time. His bread and butter is multifamily renovations. So when a property like this, like whatever we are buying, where the strategy is to kind of buy the property, do the renovations, and increase the valuation of the property, we find no other partner than Elevate, represented by George Abreu and Eric Boriwala. So currently they are almost at 4,000 plus doors. So they know what they're doing. They have they early on they did rehabs for a lot of investors like myself, but later on they themselves started buying acquiring a lot of properties, and so they currently have around 320 million assets under management, which represents 4,000 plus doors, and primarily they have their stronghold is in the Texas market. So then we have Care Ventures Capital, headed by Saji. Saji is also a Big Five. He has an experience in Big Five consulting firms, and now he started getting into the multifamily. And he's actually our boots on the ground in the Houston area. So he's a local to Houston, and he'll be our eyes and thing for everything related to this property in Houston. And then we also have Ian. Ian comes from a family office background. Family office is another legal structure which has usually 100 million assets and above. The kind like a trust. The family office is another structure. So Ian has another family office, and he specializes in again investing in large multifamily properties. So he's also on board on this deal, and he's also personally invested in almost 3,000 plus multifamily units. So I present to you a case study of what my partner Elevate and Ian has Elevate and Care Ventures together. I was not involved in this deal, but the other three partners really did the project. So we just wanted to present what this trio has done, so that just to give an idea, to draw parallels of what we have in line for the Houston project as well. So the three trio were able to acquire a property in Augusta, Georgia, 104 units, and they acquired it at 55 K per door, and they were really successful because their strength is in the capex, they're in the construction floor. They were able to do the renovations and everything, and they were really able to increase the current valuation of the property. They are currently in consideration of selling this asset because they were able to increase the net operating income quite a bit, where they were able to increase the valuation from almost 6 million to now close to like 9 or 10 million. This is what they're trying to do. And they've invested almost like $1 million on this asset. And they were able to successfully kind of increase the rents. And then now they are able to command good valuation. So this is just to give a recap on how kind of things are done by the partners, and just to give a perspective on what's planned for the project in the subject property they're discussing as well. They also acquired another property, and this is the kind of renovations that they do. So the left shows the asset which was when they bought it, and the right side shows how they kind of redesign, because that's their specialty, like that their specialization in taking down the properties and giving them the facelift and everything, and taking them to the next level. And that those two examples were just for an illustration, just to give an understanding of what the strength is and how they've been operating. And they have done just not those two assets, but there are multiple assets as well. And including me personally, I'm with Elevate. This is my third partnership. So we have other properties as well where we have that partnership, and we are kicking off an aggressive capex plan on those units that we acquired together as well. So now coming down to this particular property, I'll go over the highlights. We are buying this property for $40.5 million, which represents around 90K a door. So we are projecting to have a 12 to 13% cash on cash, which is pretty good. And we are able to do that because of a good aggressive lending terms and everything, which I'll go over as well. And we are projecting around 19 to 20% IRR with 100 to 120% return of capital in 5 years. The strategy would be to refinance in probably 2 or 3 years and exit in year 5. So there is a 6% preferred return, and there is a 2.85 million of renovation budget, and the GP-LP split is 30-70 until 18 IRR and 50-50 after 18 IRR. So this apartment complex, it's called the Graham. It's here's the address here. This is a 446 units. It's a 1976 construction, where the average square foot of the apartment starts at around 865 square feet. Again, most of this content is available for you also on the portal, so I won't go on to each individual details, but I'll just cover it on a high level so that we can move quickly to the Q&A. This is a C-class property. By C-class, which means that since it is the 1970s construction, it comes under C-class, like more like an 80, 85, early 90s, probably we can consider them as B-class in terms of the age, and then anything 2005 and above could be considered like an A-class. So this is a C-class. It is a working class neighborhood. Most of the people, the demographic speaks for it. I think it's average around like 40K, I think income, median income in this census tract. And it's predominantly Hispanic and working class neighborhood. And so it's the location and everything pretty much, where it is located. It's located in East Houston. And the good thing about that, what we liked about is in the past decade, that area population grew by 11%. And as most of you guys aware of, Texas has been on the growth path. It's been a growth story. It ranks the chart in terms of the business investments. It ranks the chart in terms of the migration and job creation. I don't really want to talk more about it because pretty much it's self-explanatory, because everybody knows about the Texas growth story. And so the population is increasing, and we particularly are excited about this property is because the kind of rent growth that the current seller has achieved in his time of his acquisition was phenomenal. And we just hope to tag along to that momentum and try to implement our business plan and kind of hit these numbers to increase this valuation to what we are projecting. So this is a 446 units, 1976 built. It's a 41 of 2-story residential buildings with a clubhouse and all the other amenities. The current market rents in that area are close to around like $1,100, and we are very low from the current market. The existing rents The lease rents are an average at around 873 right now. So that's what is more drawing us towards this property to kind of do the business plan, spend the $2.85 million that we have allocated for the CapEx, and go with the partners whose strength is doing that, and renovate 40% of the units. The existing seller, he renovated for the most part of the property, but hasn't touched 185 units. So those remain in classic condition. So our game plan is to keep up the momentum. The existing seller has spent almost $4.3 million as of now till date on that property. He took care of most of the external items. So we are not doing much on the external front, which you see from the pictures and everything. So our game plan is to work on that 185 units that the seller has left it in classic condition, to upgrade them to the next level and to try to go hit the market trend. So that's the kind of business plan that we have on a high level. So the amenities include the swimming pools, fitness center, clubhouse, and all other stuff. And these are some of the pictures of the property, the clubhouse, swimming pool area, and how the condition exterior of the property is currently. This is the representation of those pictures. In terms of the location, Graham is located, as I mentioned, in the East Houston. And again, I'm not going to go over all those details about the employers and everything, but you can just review. It's strategically located where it is quite accessible to all the freeways and everything, and to all the job centers. And that's pretty much what we like from this deal. And especially when there's so much potential to increase the rents and bring them to the market. So this submarket, the reason we are really excited about this is because this submarket has seen a very impressive historic rent growth recently. And based on the CoStar and other projections that we have seen, uh, that has been a really selling point for us on why we are hooked to this property, because the kind of rent growth, when we did the lease audits, we were really surprised at what the seller was able to achieve on the renovated units. And that's exactly the reason I've said that we want to tag along to that momentum and catch whatever that loss to lease is, and try to increase the rents, which are very beyond below the market. The effective rents as of now, they average at around 884 for year 2021, while maintaining an occupancy about 88% and above. So which represents that average rents are very low than this market, which is what our game plan is to kind of bring them to the market. So this is another slide which shows all the employment centers which are located in the vicinity of Graham. Uh, So in terms of giving the emphasis on why the rents we find to be subpar to the market comps. So this is a slide which gives the information about what are the nearby properties and what are the average rents that are going on in the close by. So if you look at it, like on the average, they're all pretty much at the little higher level than this property. And the subject property, we are at 873, which is our average, which gives an immense scope for us to kind of do the business plan as we envisioned, and try to give something and make the community much nicer, make the property much nicer, and then seek the rents to go to the market. So based on the lease audit, when we did the lease audit, one of the feature that really caught our eye was some of the leases on the renovated units that they were able to achieve. They were able to achieve very impressive rent growth. Like these are some of the units where we saw unit 138. These are some of the units which were renovated, and the prior rent was like 675, and they were able to achieve 875. So if you see all these things, this is very impressive numbers. Like it's very tough to kind of have that kind of thing. And so that got us very excited when the tenant, we were able to see that kind of impressive growth in the lease audits. And there was another video that we posted on the portal as well, which gives very granular details about our due diligence findings and what we envision for the plan for the capex and everything for the property. So I would encourage you to also look at that video, which talks about all the more details about from what we found from the due diligence. So these are some of the other units which we kind of particularly highlighting where the seller was able to achieve very impressive rent growth. And and also, like, some of you might be asking that, okay, this could be a fake number. And that is exactly what a lease audit is. A lease audit is part of a due diligence where the seller gives us access to the entire leases, where we, along with the property management company, together, we will review every lease, check all the tenant files, and ensure that these are active, genuine leases. So that audit is already done, and there were no huge red flag that came up from any of these lease audits. And those notes are also again shared in that video, which is hosted in the portal. So there were some impressive numbers that the seller, with his 4.3 million dollars of capex that he spent, is able to achieve in this property. So what is our business plan? Again, we are not doing any typical value add play. We're going to do the same thing. We're not saying that we're going to shoot the stars. Uh, Current classic package involves like white appliances and just regular stuff. So the current tenant, like as currently the tenant has the seller. I mean, the seller has renovated about 262 units as light upgrades, but based on the growth that we are seeing and what the market can support, we feel that there could be even more room to upgrade them to even next level. However, our plan is to focus on those 184 units that are still in classic condition, to give them those the upgrades. Like the current scope is white appliances, resurfaced countertops, classic cabinets with pull doors, laminate flooring, and classic plumbing and light fixtures. So the upgrades would be like new appliances, USB outlets, granite style countertops, Foxwood ceiling, upgraded lights, LED light fixtures, and kitchen backsplash and cabinet pulls. So this is a typical thing, like you guys might also hear from other syndicators when they talk about any value add. So this is in line with that. Only thing is that the partners that I'm associating with, their bread and butter is doing these things. That's the reason we're very confident about pulling it, because the partners itself are also the construction guys as well. So the average classic units are leased at 824 right now. With the upgrades, we plan to kind of increase, try to achieve the rents of at least $100 more. And we estimate the cost per unit to spend around $7,500 on each unit of these 184 units to take them to the next level. And there's some washer dryer connections as well in 2 and 3 bedrooms, which we plan to kind of put those machines and try to achieve another $40 in the additional income as well. So coming down to the numbers right now, I know that most of us are here are the numbers guys. So that's why now I'm jumping on to the numbers section, where in terms of the underwriting assumptions, we are getting a loan for 37 million. That is a bridge product. When I say bridge loan is something, is not like a, it's like an intermediary loan. So like usually you will use that whenever you're trying to add value to a property, and then your game plan is to refinance in 2 to 3 years, you usually select a bridge loan. So we are going with a bridge loan, and we're getting very attractive terms here, because we are getting 85% LTC, which means that they are covering 85% of the purchase price plus the capex plus the closing cost, excluding the acquisition fee and the reserves. So that's the reason we're getting a very good leverage here, and that's the reason our numbers are working very wonderful well. So even for that, we are getting a very attractive interest rate of 3.85%. This is a 3 years loan with an option of 1+1. So the game plan is to refinance at the year 2 or 3, depending on the execution of the business plan. And apart from So apart from, so this is the capital stack on how it is broken down. So the entire total acquisition cost, which is debt plus equity, it's a $46 million project, of which this is the capital stack. So 37 million is coming from the senior debt, which is from the loan, the bridge loan. And we are getting a preferred equity company to do some part of the 8.8 million equity that we need for this project. So of that, there's a vendor called CalCap. He's coming and doing a preferred equity. So he's nothing but like another equity holder, but he has a preferred position before the limited partners. So they are coming it with $3.5 million, which leaves us the money that we're trying to raise right now is $5.3 million, round figure. So that's the LP equity, and it's or slash the common equity is what is the purpose of this session is to raise that money. So the uses of that money is 4,500,000 is going towards the purchase price. The closing cost are including the reserves are coming at 2.7 million, and the acquisition fee, which is the fees going to the general partners, it's at 607K, and the capex we are allocating for is 2.85. And for the preferred equity, the terms are there is a in the whole period we have to pay 8%, and at the exit we have to pay 4%, and there is a 10% of promote, which is the share of a profit that we need to give the preferred equity. So that's how the numbers are underwritten. So the strategy is to refinance at the end of year 2 or 3 and try to sell that property in the year 5. However, as many of you guys you already know, the goal will always be to kind of exit the property when it is ripe, where the goal of any general partner would be to kind of exit at the highest and at the valuations where we can maximize the returns for the limited partners. So, so if the market conditions are favorable, we can probably look at an earlier exit. However, we have underwritten and everything for exit at refinance at year 3 and sale at year 5. So this is another pro forma that I would want to show, because again, we are all numbers guys. We like to see numbers. So so after the end of year 1, based on our business plan, we we are currently at 880 or something. I showed you, right? 800s. Our plan is to come to an average rent of 930K at the end of year 1, and we have given enough of vacancy bad debt coverage, almost like 20%, and our still expense ratio is still very good at 55%, which means that any multifamily properties, especially in Texas where taxes are high, usually anything expense ratio of 50 and above is good number. Means of course there is room for improvement, but again, factoring at a higher expense makes it better, so that it makes it more conservative underwriting, so that way even if there is anything we will be able to absorb. So with the 20% uh, of the bad debt vacancy factors, and then close to like 56% of vacancy, so we have taken enough cushion such as to make sure that the numbers will not go really haywire if there is even in a little bit of increase here and there. So it's an interest only loan as we presented. So this will be the distributions of the cash flow that we'll be getting. So the order is that always the preferred equity company will get their first share, which is their 8%. And then comes the limited partners. So in terms of the refinance and exit assumptions, so for the underwriting, we have taken as in year 3, we're going to do the refinance, and year 5, we're going to do the sale. At refinance in the year 3, the net operating income is going to be around 2.7, which you can see in the previous slide. So when the net operating income, when we're projecting it to be at 2.7 million at a 5% cap rate, it represents a valuation of 54 million, which represents a valuation of 121. So it could be looking a little shocking for like, how did we increase the valuation from $9 million uh, to like $40 million to $54 million, almost like a $14 million increase. And that's because commercial properties are valued based on the income and not on the costs. And since we're able to increase the net operating income by investing almost $2.85 million and try to increase the rents, that's how we are increasing the net operating income. And that's why it's commanding the valuation of a 54 million, which represents 121K a door. And that an assumption of a 3.9 interest rate and with refinance costs and everything, we project to have a refinance proceeds of $4.4 million, of which we will use the $3.5 million to pay off the preferred equity company, because usually preferred equity companies only comes in for 2 or 3 years. In this case, they're coming only for 3-year term. So we will be paying them off from the refinance proceeds. And there is a 4%, again, we only paid 8%, so we have to pay 4% to the PE at the exit. So 425K goes to that PE company, and there is a 10% promote. So if we remove all that, there is a 468K extra that we'll get from the refinance, which we'll be using it to pay the capital back to the limited partners. So the limited partners, we're also going to get some proceeds. It is not going to dilute your stake or anything like that. It's just written off your capital. At the end of disposition, in year 5, the net operating income, the much of the gain, as you saw, is we are already getting from the year 2 and 3. So 2.7 and 2.8. So we are very close. In the next 3 years, we're not saying we're going to astronomically increase the net operating income. So with a conservative 5.2 cap rate, after 5 years, we I think very feel confident that the valuation could be like 55 million, which represents per door of 125K. And for folks who are familiar with Dallas and other kind of markets like that, you know that for a C-class property, this is currently the going rate. And this we are talking about 5 years from now. And Houston, we specifically like, I didn't get a chance to really ponder on why we like Houston, is we feel that Houston is one of the large big cities where we still have a very good where we can still acquire assets at a good valuation. A C class in Dallas right now, they're going for around 125 to 130 as of today. And the matter of fact that we are able to acquire this at 90K a door, and based on analysis, there are a lot of C class in Houston that we with similar demographics, which we can acquire in the 85K range. But we acquired this at 90K a door because the seller has already invested $4.3 million as capex into it, and he already showed a path of getting to higher valuations. So that's the reason we feel very comfortable in acquiring this asset at $90 million, at 90K a door, and underwriting it that we will probably be able to comfortably take this valuation to 125 a door in 5 years from now. So with that, and we after pay off the loan, we'll get around like 6 million proceeds, which we will again have to pay a 10% promote to the PE company even at the sale, and a capital transaction fee less. Then this represents the numbers how it looks for the limited partners. So the fee 5.234, round figure 5.3 million, is what the total raise that we are raising for the common equity. So in terms of the member cash flow for the LPs, so we are projecting that they will get around 359K. Again, bottom slide will show you the same numbers on 100,000 investment. The top part is on the whole, on the project level. So we project around 6.86% cash on cash in year 1 for the limited partners, 11.63 cash on cash in year 2, and so on. It keeps increasing. That's the reason it's getting at average of 13.21 cash on cash is what we're projecting. And in the year 3, you will see I said 468K is where we are returning. If you look at it on 100,000 investment, an investor who invested $100,000 is going to get a return off capital, not on capital. It is a return off capital. So that's why around $9,000 you're expected to get return, which means that you're only will be left in this deal at 91K and not the 100,000. So after the refinance, this is how we're looking at it in terms of the capital account. And at the sale, we project around $3 million after taking care of the promote and to the PE company and everything. We hope to return around $3 million, which on a 100,000 investment comes out to be around 57K from the sale proceeds. So if you add all together in terms of the member cash flow, if you add this around 62K, is we are projecting that is coming from the member cash flow on a 100,000 investment, and around 57,000 coming from the sale proceeds. So together that represents around 120K upside on a 100,000 investment, and that's how it is projected as 120% return, which you divided by number of years gives you an average annual return of 24.15 in an IRR terms. Some people will get confused if I talk about the definitions. For some people who already know what IRR is, that's good. 20 IRR is a great IRR. But for people who don't know what IRR is, it's a number to know the time value of the money. And I won't go into much detail because it's a financial concept. It'll take 15 minutes to probably explain that. So if in an IRR terms, it comes to around 20.05. So in terms of the equity multiple, it's 2.21 for people who already know what the equity multiple is. Equity multiple is for every dollar you spend, how much it is being multiplied. So in this case, since it is 120% is the upside, so that's why it is saying it is 2.21 is the multiple we are projecting. So in terms of I know some of the people are also curious to know why this multifamily have tax benefits. And this is where we explain what kind of tax benefits we get. For multifamily properties, we have some advanced strategy that we use called cost segregation. In layman terms, what cost segregation is, if you take any commercial property, there is a land portion and there is a building portion. Land can never be depreciated, but the building can be depreciated. In a general IRS tax code, any commercial property can be depreciated in 39 years, which means that if a property is, let's say, $1 million, if the land value is 250K and the building value is 750K, you can depreciate that 750K in 39 years. So 750 divided by 39, whatever that number comes to, is what you could use as a depreciation in the year 1, year 2, and everything. That's called straight line depreciation. However, we have a concept called cost segregation, wherein instead of waiting for 39 years, what the study done, it's an engineering study. We hired some professionals for it. So they'll come in and then the breakdown and the entire apartment complex into 5 years depreciable item, 10 years and 15 years. They will allocate the entire building into different components. For example, the appliances could be in like 5-year depreciation cycle. They could see amount of the plumbing, the amount of copper, and so on and so forth. So they'll break down the entire building into individual components so that we will be able to depreciate it at much faster pace. And combined with the Trump taxes that we have, which includes a bonus depreciation. So with all those combined, in the net effect is that on a conservativeness, if somebody invests $100,000, very basic, we are saying that they will be able to get around 63,000 as year 1 depreciation. The best case is that you will probably get around 92K in the depreciation. So which means, to explain in again as simple terms, if some investor investing $100,000, his year 1 is probably getting we told 6.5 cash on cash, right? So probably they'll be getting $6,500 in terms of proceeds in the year 1. So they will get 6,500 as proceeds, which they would have actually paid taxes. But there is a depreciation that, let's say hypothetically, will take average, let's take it 75K. So 6,500 and the depreciation is 75,000 negative. So they will get their first year K1 for negative 68 something, whatever that comes down to. So which means that technically the year 1, 6,500, you don't have to pay taxes because it's tax deferred because you have a negative K1. So even the same second year also, you might get similar negative number, because if you don't use that number, in the first year. Let's say you have a condo that you're selling in that year. So you have a real estate gain. So you can take any real estate gains and offset with this real estate losses. So that's how you can, if you have any income coming in, gains coming in from real estate, you will be able to use that with this negative numbers to kind of offset that taxable event. So which means that you can kind of defer those taxes. However, at the end, when we sell, these numbers will catch up. But again, there are some strategies through which you can defer it at that time as well, which I'll go probably in the live Q&A session. Uh, and because in interest of time, I would want to wrap it up because it's been almost 45 minutes. But we will probably deep dive if somebody has detailed questions on this cost segregation and how this tax benefits works. So in terms of the timelines, we are already past all these stages. So right now we are at the almost tail end of this project. Uh, we are tentatively closing on November 9th, which is almost like 2 weeks from now. So there is a little bit of timing is of the essence on this project. We unfortunately, I couldn't bring this project to you guys little early on because of some other things on my part. But so that's the reason we have little shorter time window on this project. So it is for people who are up and ready to get onboarded on this kind of project. So we are ready uh, to accept the interest, the commitments, and the wire funds from this week until end of next week. So until November 3rd, we hope to kind of finish this fundraising, and because November 9th is the closing tentative closing date. So all the information is hosted on the investor portal, and most of you should have the link to the portal. But even if not, this I'll also again also post it in the chat window. So there is that link takes you to the investor portal. So when you click on that investor portal, you will be able to register yourself if you haven't already registered yourself, and then you will be able to see this offering, and then you will be able to see all the documents, the subscription documents, and everything, and you will be able to put your commitment, and also it will show you the wire instructions and everything. And this is a 506c offering, so it is only for accredited investors. And as part of our rules of 506 offering, we also need a verification from a CPA that you are an accredited, any verification to prove that you are an accredited investor. So an accredited investor means any individual, if he's single, if he is making 200,000 or more in past 2 years, and if his wife and spouse together, then it is 300,000. That's the income requirement. Or he could also qualify with the net worth requirement, which is if he has a net worth of $1 million and above, excluding the primary residence. The assets could be global assets, so it could be India assets as well. So cumulatively, if they have 1 million net worth and above,
break for dinner, please. Dinner చేసి ఇష్టమైన అందరూ పడుకున్నాడు తమ్ముడికి ఫీల్
I'm sorry, would you be able to unmute yourself? Mute yourself, sorry.
Kumar, try to mute everyone once. If somebody wants, they can unmute.
Yeah, anyway, we are almost at tail end. Yeah. So, yeah, so there is, we could give access to Verify Investor portal. However, where you will be able to kind of upload your pay stubs and everything. This usually works for US assets, but if there is any India assets and things like that you would probably want to put yourself to be a qualified as the accredited investor, I would highly suggest is to work with your own CPA to get the drafted. So in general, it is better to get this letter from your CPA is the most simple way. If not, again, if there is just US assets, then we can also give you a pass for the verifyinvestor.com through which you can be able to upload your documents and get that letter certifying that you're an accredited investor. So this is a first come first serve opportunity. So if anybody is seriously considering this, since time is of the essence, so we encourage you to immediately sign up using this portal link and express your commitment. So once we acquire this property, in terms of what you should be able to expect is we're gonna have the monthly reporting, and we also give quarterly numbers, and the distributions are we say any time between 3 to 6 months they will start. The goal will always be to give to start it earlier than later. So we project it to start the distributions anyway from 3 to 6 months time frame since we acquired this property, because it usually takes around that much amount of time for us to acclimate with the property, for the property management company to take the operations under their control, start implementing the plan, know the clientele, tenant pool, and everything. So there is usually a time frame which is usually required for things to become a little bit of stable and controllable. So communications and everything will also be coming through portal and everything as well. So I would, before we jump into the Q&A, I would also want to maybe show uh, the portal. So when you click on the link, I'll post it in also in the chat window. The link, you will be able to see this screen, the portal link, which hosts all of the information without any registration. You'll be able to view all the documents. The webinar deck is presented here, and this is the videos of the property, and this is the due diligence notes that my partner put together. And so you'll be able to access all the PPM and everything. But in terms of you to express your interest, you have to click invest now. And if you haven't already registered, you have to register. When you click that, you will register and it will give you the option, and you will be able to express your commitment. Pretty seamless. It shouldn't be that much difficult. So with that, we open up to the Q&A. I know we went a little bit more than what we anticipated. So let's get started with the chat questions in the chat.
Hello. Hi, Kumar. This is Srinivas.
Hey, Srinivas.
Yeah, let me just like open up myself that way. At least you know who's talking to. Okay.
Sure. Yeah.
Yeah. Hi, how are you?
Good. How are you?
Yeah, I'm good. I'm like, I live in like Lansdale, suburbs of Philadelphia. My question here in that thing, anyway, thanks for like beautiful presentation there.
Thank you.
One question that I caught my attention is, after 3 years refinance and 5 years refinance, 5% and 5.2% cap rates, right? Is that like underwritten already on those? Because I'm not sure Houston area, what is the cap rate going on right now for residential multifamily? Is it already underwritten at that percentage, or is like approximated?
Yeah, very good question. If you if you currently see the entire landscape of how everything is panning out right now, there are a few markets right now where these even C class are going even at 4 caps as well, especially in Texas markets. So Houston is as I told you, right? Houston is probably still the large big city where still we are able to acquire something under 100K a door, with cap rates still hovering around like 5-ish and everything. The anticipation, the amount of liquidity that is floating in the market right now, the post-COVID, and the amount of capital that is chasing the yields, the consensus is that the cap rates are going to be further compressed from what they are as of today. And especially Houston, the consensus is that these price points of under 100,000 a door are not going to be remaining because of the way people are chasing for the yields. Because there are, as I mentioned, the A class are now in some markets, some strong markets are going at the 3 caps, and then B and C are followed by respectively at the 4-ish caps. Few years ago, these were not even the cap rates. But the consensus is that the cap rates are projected to be shrinking from even further from what they are right now. So at 5.2 and 5-ish cap rates, we still feel that based on at 5 years from now, I think we still feel that it is because you have to go with some estimate. You can't say 10 cap rate and underwrite a deal. So you have to
Right,
also
yeah.
be in line with the market. So that we feel is the best case scenario based on our experience and understanding of the markets.
Okay.
But
So right
again,
now it
nobody
is
is a
like,
god. Nobody can predict the
yeah,
future. So the goal is that we can never eliminate risk. We can only mitigate the risk, and
yeah.
we do with the best of our abilities and judgment.
Yeah, compared to like that 5 and 5.2, like what are the cap rates? I mean, what is a shrinkage of cap rates in the past like 5 years, I would say.
Wow, it is definitely a lot. In 5 years, I would say at least by 2%, at least 2%. The
Mhm.
C class used to go around like 7-ish long time ago, like before this entire 5 years bull run that we had. C class used to be around like at least 7-ish cap rates.
Wow.
But
Okay.
if you see, it is not only about the cap rates. The way things work, it's at the spread, because the
Right.
interest rates also went down. So they, at that time when the 7 used to be the cap rates, the interest rates are also used to be at 4-ish, 5 close to. So
Right.
still the numbers still work because it's always about the spread, not effectively about the cap rate, because it's the cap rate but the combination of interest rates together is the spread will still make the deals work or not work. So it's always about the spread usually. So that's why we have to always look at from the both aspects of where the interest rates are heading plus the cap rates and everything.
Right. Yep. Okay. Yep.
Yeah.
Thanks, Kumar.
Yeah, thank you. So let's start with the chat questions. What is 6% preferred return? Good question. Yeah, I should have little explained the preferred return. Preferred return is nothing but it is something that is owed to you irrespective of not. Let's say in the first year, we are not able to achieve the 6.5% return that we are projecting. Let's say we are able to only get 4%. So then we will only give you 4%, but since your preferred return is 6%, we still owe you the 2%. So the 2% will owe to you will be caught up in the next year if there is enough money for that. So that's what is the definition of preferred return, which means that no matter what, the profit sharing will come only after you get your 6%. That is the preferred return. Preferred equity. What is preferred equity? Preferred equity is a is a is nothing like a, it's like a PE company, private equity company, which invests in multifamily properties, and they are looking for parking their money. They get their money from different sources. They're like Wall Street firms, or it could be private firms. They're just like how in Wall Street you hear the PE companies, private equity companies. So the preferred equity companies are those kind of companies who invest in these multifamily properties, and they get a preferential return. So that's why they are investing the $3.5 million in this project, like an LP, another LP. But just because uh, they're getting the preferred term, so the return is less. So we don't have to give them the complete upside of 24, 20 IRR and everything, because they're fine with 8% plus 4% plus the 10% promote. There is no mention of 50-50 after LE, and that only comes at the exit. And the $3 million that we put together is taking into that consideration. That the after, because we projecting 20 IRR, right? So until 18 IRR, it is 70-30, plus after that 18 IRR, whatever that amount is considered a 50-50, and that's how we're projecting that $3 million as the LP returns. So it is accounted for already on the returns.
Hi, Kumar. I have that question.
Mm-hmm.
So I looked at that LLC agreement and also the PPM.
Mm-hmm.
The only mention I see is the 70-30 distribution. Nowhere there is mention of any 50-50.
Absolutely. There is an amendment that we are also yet to receive from the attorneys, which we'll be attaching pretty soon. And you would have to sign that amendment as well, which includes the PE company and also this 50-50 split. Very good question, by the way.
Thank you.
So, okay, next.
Kumar,
Yeah, go
Srinu.
ahead.
So is this opportunity open only for accredited investors or only
Yes,
anyone has a
this
capital?
is a 506C offering, as I mentioned. So it is only for accredited investors. But as I said, it also includes overseas assets as well. So please take a good look at your overseas assets as well. And if you can able to get a letter from your CPA to verify those overseas assets and you're able to get a letter, you'll still be able to qualify as an accredited investor, if not for the income. If you qualify by the income, then it's no issues.
So Kumar, like what kind of proofs are required? Or can they just do self-attestation?
There is no self, you should not do self. Only in 506B, you can do self-certification, but in a 506C, again, it's not our rules, it's strict guidelines of SEC. So we have to get verified proof in order to access.
Yeah, no, but for the people showing the Indian assets, do they need to submit the proofs of the land documents or something like
That is something that whoever is certifying, probably you have to prove it to him. So what kind of proof that he is comfortable in order to certify that you're accredited investor? So it's totally up to him what kind of verifications. It's mere he has to be comfortable in order to certify you as an accredited investor.
In the closing cost, I see there is a 600K, right? Goes to whom?
To the general partners. It's
General partner means
general partners, all 4 companies. So my company, all the 3 companies who are doing the entire work. So those are the general partners.
it's like management fee.
Yes.
Kumar,
Not managed. Yeah,
quick suggestion. When somebody asks a question about numbers, can you put that slide?
sure, absolutely. Let's go there.
That way we know it.
Sure. Yeah, this is the slide that we were talking about. So the $670,000 is the acquisition fee. There are a couple of ways in which a general partner makes money, right? So at the initial phase, at the closing, for all the work put together this deal and to do the whole zillion hours that we spend due diligence and all that stuff. So we get an acquisition fee. And then there is an asset management fee of 2% that you get from the cash flow. And the third thing is, and that everything is in the PPM. Everything will also be on the PPM, which you are going to review and sign as well. And the splits of the profit is how the general partner makes money.
The split is also 50-50?
After 18 IRR. As I
Okay.
mentioned, right? After 18 IRR, the split is 50-50. So until 18 IRR, it is 70-30. Only after 18 IRR is met, whatever that additional delta is split as 50-50.
So for the 6% preferred returns, the 100% goes to the investors, and then after
Yes.
that,
Right. The
After that
6%
only-
preferred, yes. First, the chain of events is the preferred equity gets their 8% because they are in the first in the line. Then whatever is in the cash flow left, then the 6% is tried to be first honored for the limited partners. And if that is met, and then comes the split of 70-30. 70 going to the
So,
limited
Kumar,
partners and 30 going to the investors.
for the preferred share, preferred equity?
Right.
So at the end of year 3, like you are paying them back what they invested,
Right.
plus the 8 plus 4%, right? 12%.
Right. Plus the 10% proceeds from the investment. That's how our terms with the PE company is.
So that is end of year 3 or end of year 5 when the exit
We
happens?
we have to give them at refinance event, any proceeds that we get, and we also have to give from the proceeds of the sale as well. Those are the terms that we have with them.
So we are giving 10% 2 times or?
Not 10%. 10% on what we get the proceeds from the refinance, and 10% of what we get from the also the sale as profit.
So overall, how much are the equity partners making at the projected numbers? What is the percentage? 12% plus how much?
12% plus, I don't have the math with me right now. Yeah, but they make around another 500K, something like that. Yeah.
Is it 10% of the profit or a 10% of the refinance amount or a 10% of the sale price? Because there's a difference.
10% of the proceeds that we get after we pay off the initial loan and everything, not on the entire refinance amount. After we pay off the investors and everything. So let me go to the side. So the 4.4% of the proceeds that we get, after that, from this, we are paying off the PE 3.5%, 3.5 their original principal, right, that we have on the PE. Then their 4% at the exit we have to give them, which is 425K. So the 10% promote, which comes to like around 520 is what it comes in. So 10% of that is 52K. And that's why 468K is what we are giving it back to the investors. So the 10% of the final number.
Come again, 10% of what appraised
520K. 520K after you give 3.5 and you minus 425K 4%, what is remaining is 520K. That will be 52K. See, these are complex maths, so that's the reason we don't pick, because it kind of, you can sit for almost 1 hour just talking about the numbers. So that's the reason we don't, but if you need further clarification, we can provide that details furthermore.
Okay. So yeah, this makes sense. So 10% of the remaining,
Right,
about 4.5
right.
million, you pay about 4 million to them, and 500,000 is remaining, and we give 10% of that. Okay.
Mhm.
And how about the exit scenario? Can you show me the exit scenario, please?
Exit is a little more complex. That's the reason we don't have it, has to be in a spreadsheet, because again, we could be end up talking about those numbers for like almost 1 hour. So that's the reason, if you can reach out to me and I can send the details about how the exit math is all working.
Yeah, this is not part of the slide deck. If you can include it, that will be great.
Yeah, sure.
And how about the
So-
refinance costs? It's 2%. So who's getting that 2%?
To the whoever is going to be the lender.
Is that all 2% going to the lender, or are the general partners or
No,
anybody
there
else
is
making
no
money?
partner. There is no fee to general partners. It is to the origination fee, closing costs, and all that kind of stuff. So we are putting together a round figure of 2%.
So those will be actuals, right?
Yes. Again, this is all projections. This is nothing standard. Like we have to, it'll happen based on when the event happens. This is just a
And this
projected
will all be
number.
disclosed, like who are the preferred equity partners? That information will be disclosed.
Yes, it's CalCap.
Okay.
CalCap is the preferred equity company.
Okay, this is not from individuals. It is coming from
No, it is from a PE company. It's a professional company who have a different structure. They have their own terms. They have their own underwriting. We have to pay their underwriting fees and everything. There's also a clause involved to get a PE company. And that's why the reserves and closing costs are quite high, because it includes all of the stuff. So let's
Kumar, can you quickly go through the questions that people posted in the
Yes,
chat?
exactly. That's the reason. In the interest of time, I need to quickly go through. So cash flow is size 2600 and not in sync. What is not in sync? 26 and what is 27? What is not in sync?
Okay, so that question is from me. If you go to slide 26,
Okay.
cash flow was 780, 786 or something like that, right? The final number.
Okay.
And then if you go to next slide, that's right, slide 28,
Mhm.
distributed amount is only 368.
359?
Yeah.
Yeah, because we have to pay the PE company and that's right. After the PE company, this is the number.
Right. Okay. So
Yeah.
okay.
Right.
Yeah, that wasn't there.
Yeah.
We missed that part. PE company.
No
It wasn't
problem.
there.
Yeah, I understand. Yeah.
Okay.
So what is GP? GP stands for general partner, as I explained, who's another way of saying managing partner. What is a bridge loan? Again, I explained. Do you share all the lease due diligence and other pre-acquisition homework with investor? Yes, if you require, we definitely don't have any problem. So hearing that. Houston market largely depend on oil companies. What original? Okay, perfect. So one of the also reasons is is that we think that Houston market is just oil dependent only. However, if you really do the deep dive, you will know that oil represents only 2.7% of the economy. And oil and oil service based industries are right now only 7.5% of the economy right now. So it's on a high level, we think that Houston is just oil, but right now I think Houston has grown much more beyond just dependency on oils and oil related energy structure as well. Can you please brief on what sort of transparency to investors is given and provided? What, again, you have to explain like what you're expecting, but everything is shared and everything is, quarter report is shared on a quarterly basis. So the P&Ls and everything is pretty much shared. So you should be able to see everything as well. And probably somebody who's done deals with us in the past, they'll also be able to kind of give you what kind of transparency we have and everything. The property is built in 71 and after 5 years, it will be age 66 at current date. How do you justify price increase, capital appreciation? Even the 1960s product are also at 85 a door right now. So that's how the justification is, because it is not based on by the comps, as I mentioned. The property valuation is based on the income. So if the income is like a lot more than that, even if like New York City apartments are 100-year-old apartments and they still have a value. So age is always not the only criteria in evaluation. So is this property already acquired? No, that is the reason of this presentation, because we need that the $5+ million of common equity to close on the property, and that's the reason we are doing the presentation. Can you share the refinance exit numbers? It is not on the deck. Yes, I can give, but it's a complex math. That's the reason we don't, because that will take the conversation to, that's the reason we didn't include them, but we can definitely share it with you. Can we write off W-2 taxes with this depreciation? No, you can only if you're a real estate professional. You can Google what is the definition of real estate professional. Your primary income has to be from real estate, and you have to give enough number of hours to qualify as real estate professional. So only then you will be able to use it against the regular income, but if not, you cannot. How much is raised so far? Today is the first days of presentation, so we have not raised anything as of now. We're starting to get commitments. And good question, how much is GP investing? In any apartment complex, any senior lender, when they are giving 37 million in this deal, right? Senior lender always warrants almost close to 10% of the common equity to be coming from general partners. So this is a requirement from the lender. So in this case, 530K has to come from general partners. So we have no other option. We have to invest 530K as the GP investment in this deal. Do you plan to hold the property for longer term if there is a downturn? Yes, that's the beauty of the multifamily and any cash flowing property is the goal is to kind of exit to maximize the return. But however, if there is any downturn and everything, but as you know, we had the worst of the worst real estate crisis. But the sector that had least impact is multifamily, because multifamily is a basics business. So we are in the business of providing shelter to the people. And just because of the people don't run away. So they still need a house and shelter. So they could be maybe a little bit of concessions and things like that people have to give a little bit more. But on overall, this is a very good asset class where even at the downtowns, they really perform well. So worst case, yes, we will be able to hold on, because as long as it's cash flows, we should not have any problem holding on to it. Can we invest IRA funds? Yes, you can, as long as the funds go from a self-directed IRA. You have to open an account with a self-directed IRA vendor, and through the self-directed IRA vendor, you will be able to invest in this real estate projects. The minimum investment is 100,000 in this deal. What is the timeline? I mentioned November 9th is the closing date, so it is we are expecting to raise the funds sooner in the next 2 weeks. What is the potential risk in your assumption of not being able to achieve target returns? What is the estimate range for IRRs for a potential down and upward assumptions? So, hi Sudhakar. Hey, Dave, definitely, you definitely are much experienced in this. So you're talking about the sensitivity analysis and everything. So if you look at most of the apartments in what we buy, they usually have a break-even occupancy in like 60 to 70% occupancy. So as long as we maintain that kind of occupancies, we should be able to comfortably give the debt, senior debt servicing. So since there is a PE component is also involved here, so that adds a little bit of extra percentage to the occupancy. So in the worst case scenario, we still say that the projections are going to be in the vicinity of like 15 IRR is probably at the minimum we will be able to achieve, even if we factor some of the hiccups and everything. But again, the whole reason that we like this property because of the rent growth that's happening in the Houston submarket, especially in this area. Double-digit rent growth is being pretty common in Texas all throughout. And that's the whole point, is to come implement the business plan and exit really quickly. So you don't want to keep it for like 10 years and then something could happen. So the plan is to come in, implement our business plan and exit. So you're not holding on to this for forever and taking any risk. So what does cash on cash return start once you finish renovation after money is given? What does cash on cash? Yeah, I already explained. So they start from either from anytime between 3 to 6 months. The sooner is what we will try to do it. But it all depends on how much we are acclimated. Based on that, we will kick off. But it is the money, you will get it from the day that you have invested. So only the distribution starts from that particular month, but you accrue for all the months since you started investing in this. The deal is closed, not given, but the date of the closing of the deal, because you make money from the day we close the deal, not the day when we receive the money. Is it open for accredited investors? Yes, only. Do you expect any income impact due to federal rent moratorium? Federal rent moratorium is, first of all, Texas is a very landlord friendly state. That's one of the reason I didn't mention that in the early on as to why we like Texas, is because unlike New Jersey or New York or California, Texas is very tenant friendly. Landlord friendly. So the evictions and everything in New York, New Jersey, they take forever, like very long time. In Texas, it's pretty fast. And all the negatives of those moratoriums or everything are coming to an end. So when we are entering into this picture, we are not really worried about the moratorium and the impact that is going to have on this property, because we are almost at that far end to that entire cycle. Can you share the recording, please? Yes, the Zoom recording will be hosted on the portal, so it will be available to everybody. And also an email will go on to all of the participants with the link and all the information as well. Does anyone reserve study analysis? What is the near-term investment for structural deficiencies that arise by the time reaches 5 years from now and everything? Great. Since you guys are construction background, you're talking about everything, and that's the reason we have our partner who is from the construction background, and their bread and butter is more doing multifamily renovations. All of those studies, all of those due diligence is performed, and that's how we take into everything into account before we end the due diligence period. How long will it take to get accredited? Will we qualify with income? It shouldn't take more than a couple of days. And again, if the easiest is to, if your CPA can certify that, it's just depends on your CPA time. So that's probably the easiest and quickest route, because you already have a relationship with CPA, and so he can probably give you a letter much faster than you providing information to some third-party website. Can an LLC invest in this? Yes, absolutely, an LLC can invest in this. Selling at the end of 5th year versus after era, what does that mean? So what does that mean is if you make a particular kind of return and you're making 18%, forget about IRR, let's take it just as a return, as a yearly return. If you're able to make 18% average return, until then the split is calculated on 70-30. So let's say anything above after that amount is taken and calculated as 50-50. And whatever the numbers we presented to you does all these calculations already. Generally, cost segregation related depreciation doesn't go to GP until all LPs capital is depreciated. But in this case, it says depreciations are also divided 70-30. No, depreciation is never divided into 70-30. It just goes by the percentage of the share allocation. There is no split of depreciation. So I don't know why you got that idea, but depreciation is not split 70-30.
Looking at the slide, that's the reason we got that impression. The depreciation slide.
Depreciation slide. This is just a study and everything. But again, yeah, we can.
It's
reach out to me and
right.
we can connect you to the cost segregation expert, and we can share more information on that as well.
Yeah, it's like a 70% LP split, 30% GP split. That's the reason we got that question.
Okay.
Yeah, the first row is the one confusing, Kumar. The first row says actually 70-30. That's the one.
Yeah. So it is just talking about the basic terms of this deal. So that's why probably you're convinced. It's just talking about the GP splits. So that's why probably, but its depreciation is not being split. So based on our share, we will get our worthy depreciation. So there is no.
But 100% of the depreciation goes to the LP, and the preferred
no, GPs are also LPs. You have to understand GPs are also LPs. Because our 530 are also going towards as LPs. So we are also GPs and also LPs. So we will get based on our share of LPs. So all the LPs, all the money partners will get their respective depreciation.
Does the preferred equity investor get any depreciation?
No, preferred equity, good point. Very good question. Preferred equity doesn't require the depreciation. So we, as common equity, get the entire depreciation. That's very good question. I actually didn't cover that, but thanks for bringing that the question.
Thank you.
What is it? Repeat, please.
The preferred equity, the PE company is not getting any depreciation benefit. They don't need the depreciation. That's how the terms are. The CalCap company, for giving the $3.5 million, they are not getting the depreciation. So the entire depreciation we are going to get. All the common equity holders are getting the depreciation. The main employers, tenants, current living in, it's on the slide. I don't have it on top of my head. So I would encourage you to just look at the slide if you don't mind. Current occupancy rate right now, based on the audit, we are at 90.8 or something, if I remember correctly. Did the option period expire? What if you can't raise 5.3 million since it's a top 5 frame? That's not a problem. We are definitely looking very strong. The numbers are very strong in this deal, and I don't anticipate that we should have any problem raising the $5.3 million.
Did the option period expire?
No, it didn't expire.
When does that expire?
November 9th. November 9th is when we exercise one option. So November 9th is, that's reason is our kind of end date. Yeah.
So option period expiration and closing date are the same.
Right. Right.
Okay. Thank you.
Couple of questions. We can group with other friends, create LLC and invest. Yes, absolutely. You can do that. If we can both friends income together considered as three, unfortunately not, because for an LLC to be considered accredited, their individuals have to be considered accredited, or the LLC, the corporation itself should have an assets of $5 million and above to be qualified. So can we invest money that is in India? Unfortunately, yeah, if you do, LLC can also have a foreign member. So you can, I think the best thing is you talk to your CP on how you can structure it. You can put that into an LLC, and then an LLC can invest as long as the LLC has that funds and they are accredited. For individual investors, the criteria is investor need to be accredited. But what is the requirement for LLC? As I mentioned, like LLC, the individual members have to be accredited, or the LLC itself should have like $5 million assets and above and all that kind of requirements. The exact definition, again, there are many other things which are very higher level advanced in terms of what the qualifications are. Whatever I'm mentioning are only the basic ones, which most 90% of the time people fit in. What are the risks involved? Perfect, very good question. And as I mentioned, right, we can never eliminate risk, we can only mitigate the risk. Here, it's a rental property, right? Bottom line, it's a rental property. What is the risk here? The risk here is that if one fine day everybody thinks that we don't want to live in this apartment and just move out, that is when we will have a problem, because then we don't have any cash flow and we have to pay the loan amount and everything. So that is the ultimate risk. But so what is the probability of that happening is that's how we invest in not a brand new construction. We invest in properties. This property has been there for decades. So there is a historic things. There are people living in that. These areas are seasoned. There are jobs. There are growing markets. Houston is still a growing city. So these are the factors in which you have to take a probabilistic approach of what the risk is and just move forward. So as I said, we can never eliminate risk. We can just mitigate it to the best case with our experience and just move forward. Who only accredited in a salon? Why only accredited? This is because this is an SEC requirement, because this is a 506C offering. So it is their requirement. If a 506C offering, we have to make a call if we have to do 506B or 506C. 506C allows us to post this in the internet and everything. So in order to have that ability to post it on the internet, we have to go with 506C. Unfortunately, if the SEC mandates only to accept accredited investors. It's not our requirement, but it's an SEC requirement. And all these investments are under the preview of SEC. So so again, it's the securities and everything. I don't want to go on because of the time factor. I want to limit the short. But again, you can Google what is 506 offering and accredited. We will have ample information about that topic. Will you be able to share the template that we will be shared with investors along with Simplistic's exit strategy? Yes. So any more questions on the chat window? I completed it. Any more? Yeah.
Kumar,
Yes, Narayan.
quick question, Puli. Yeah. When that hurricane came, I don't believe that the east side of Houston affected, but do you know how this apartment complex did? Did they have like water in this side of town or not?
I don't recall anything negative flag that, because like as I mentioned, right, you also part of the other properties that we have hosted presentation. When there is a significant event happened because of natural calamity, we already know that and we accounted for that. In this case, we haven't had any of that information.
Yeah, I think it is the west side of Houston, but not east side. That's my understanding, but I just wanted to see if you researched that, like flood zone side of.
Yeah, we did. Again, we didn't come across anything that is of worry for us. Yeah. So again, I'll post in the chat the link to the portal that will take you to the portal. And I'll highly encourage for people who are serious to take time, few minutes to click on that link and then express your commitment if you're interested. And again, it has all the documents and everything. So you will be able to review and everything.
When will the updated LLC operating agreement and PPM be available with the new terms like 6% preferred and 70-30 and 50-50 distributions?
Yes, I'll ensure that by tomorrow, because time is less, I'll ensure that tomorrow we'll talk with the attorneys and get it updated. And you will get an email once the updates are posted on the portal.
Okay, thank you.
So any more questions? So I know that it's 1.5 hours. We exceeded by 15 more minutes. However, I still want to answer as many questions as we have, but also want to keep it short because in the interest of everybody and being a Sunday night, can you share how much has been raised so far? As I said, we just started. This is the first day of the presentation. So again, it is our worry. So So it is not your worry on how much is raised. So if you are interested, I would encourage you to do, because if we don't raise money, deal is not happening anywhere, right? So it should not be an actual worry for you in terms of how much is raised so far. So let us handle that kind of worry about how much is raised. I'm sorry, I'm not trying to like discourage or not answer the question, but I don't have that yet because we just started the raising. Of course, I'm delayed a little bit, but we feel very confident about the raise because everything is in line and going in the right direction. So any more questions before we wrap it up? We can take a minute or two. It's 1.5 hours. So if there is any more quick questions that we can answer. And again, my information is out there. You can directly reach out to me. I'm available for any questions that you might have not thought about today, but still have it, dude. And you will get an email. All the registrants who joined these sessions, you'll get the email with the link as well. So take some time to kind of go the link, review the information. And if you're interested, please express your commitment as soon as possible. Is this my first project? No. Probably you missed out on the initial slide where I showed my experience. So this is for this year, this is my 4th or 5th because there are 2 deals that are going in parallel. So you can consider it as 4th deal for this year and 5th deal in multifamily. So any other questions before we end this? It's 10 o'clock, so we can take any last question. Okay, great. So I think, yeah, thank you very much for taking your precious time on Sunday night and sitting with me patiently for 1.5 hours. I hope I added value to your time that you have spent here. And I hope that you all come on board on this project, and we hope to all make money on this deal. With that, I sign off. Thank you very much.